What's up, everybody? Welcome to another edition of the Free Toaster News Pod. I'm your host, Carlos Caro. I'm here with Toaster co-host and co-founder Nick Madrid. Today, we're going to be talking about Capital One's earnings report. It went out on July 21st, and we're talking about Q2. And this is interesting for us because they run one of the biggest acquisition budgets in all of consumer lending. And then once a quarter, their execs get on this earnings call and they talk about, in their own words, how they're buying media, how they're thinking about it. So you can almost think of this as your competitor's playbook out loud. Nick, before we get to the details here, this result on their marketing budget growth didn't come out of nowhere.
No, it did not. The lead up actually makes the quarter more interesting, I think. A quick recap of Capital One's year, and I'm leading a lot on B of A Global Research. They have really good coverage, in my opinion. Back in January, Capital One announced it was acquiring Brex, the corporate spend platform, for about $5 billion. And that deal closed early in April. And then the first quarter earnings in April were actually a miss. Margin came in light. The big surprise was a reserve build. And they added loss reserves when the street expected a release, partly because they were weighing down downside economic scenarios, a little more heavily. And so the May and June operating updates showed charge-off and delinquencies beating typical seasonality. So coming into July, you had a company that had been cautious on paper, while its actual credit performance kept getting better.
Right, and that sets up the earnings release.
Totally, yeah. So Q2 was the quarter the caution unwound. So adjusted earnings was roughly 20 to 25% higher than what B of A and consensus were estimating. And the beat was driven almost entirely by credit. So instead of building reserves like they did in Q1, they released it in Q2, around $660 million, including $705 million released in domestic card. So net income came in at $3 billion, and then most of the coverage stopped at that headline. We read the press release, the call, the 10Q, the research reports, and we pulled out 5 things that marketers should actually care about. But before we get there, why don't you help us out, Carlos?
Yeah, and before we dig into that, wanted to plug our summit that's coming up. So the Affiliate Marketing Summit for lenders and publishers. We have a lot of interest coming in this week, probably because our early bird expires this week. So it's moving. It ends on Saturday, August 1st. So you're probably listening to the pod on Friday, which is when we released it. Tickets move to $14.99 and they'll stay there until the day of the event. But for those of you that don't know about this, we're bringing together both publishers and lenders, a small curated room of 150 people in downtown San Francisco. We're hosting an event at the Exploratorium. We want to thank our sponsors that have helped make this happen: Experian, Engine by Gen, Prism Data, Tear, and EXL. You can learn more about this at events.thefreetoaster.com. The links to it will be in the show notes. So, Nick, let's move to takeaway number 1.
Okay, number 1, one of the biggest marketing budgets in lending grew 23%. The company marketing expense in the quarter was about $1.7 billion, up 23% year over year. And CEO Rich Fairbanks spelled out the drivers on the call. Yes, the addition of Discover, but it was also higher legacy Capital One direct marketing in domestic card and consumer banking, increased media spend, and continued investment in premium benefits.
Yeah, no, so when we strip out, they said legacy, so we strip out the acquisition. So the original Capital One products, their original marketing engine is spending more. So this is across what we believe is going to be direct mail, affiliates, paid search, paid social. It's likely probably the core of their mix. And these are the channels we think you all listen to, our audience. So short way is saying we think competition's heating up here.
And I think one of the wrinkles from the research reports is that, marketing was up 11% quarter over quarter, but B of A pointed out that normal seasonality means the back half spend usually runs higher. So I think, you and I were talking, whatever the pressure you felt in the first half of the year, there's probably going to be more of it in the back half and in Q4.
Yeah, and Nick, before we go to takeaway number 2, I've actually had industry friends contact me asking, if I know of anything that's going on in the market. They've seen softer results than normal, et cetera, et cetera. So I've already talked to lenders firsthand that have noticed changes in their programs. And now that we're reading the results here from Capital One, and kind of this quarter over quarter and big year over year increase, I just wonder how much that had to do with it. So takeaway number two, so their spend is growing 10 times faster than the balances on the card book. And it seems to be happening on purpose. So Nick, can you walk us through those numbers?
Yeah, so total card purchase volume at 253, almost 254 billion, was up 26% year over year. And from the CFO Andrew Young, legacy Capital One volume, including Brex, was up about 14%, mostly organic. Meanwhile, domestic card balances at period end were only up 2.6%. So spending up 26%, but balances only up 2.6%. And I think that was interesting. So
Yeah, no, and it seems strategic. So Rich talked about it on the earnings call. He mentioned that the focus on heavy spenders at the top of the domestic card market. So they're investing in things like premium benefits, lounges, and just building out the travel business. And they really want customers who transact, not necessarily customers who revolve on their cards. So for marketers, like the segments they're pouring money into are going to be premium, high-end consumers, probably the same ones Amex and Chase are fighting over. So if you monetize on interchange engagement, that's going to be now a competitor that is going to come in stronger. But before we get into kind of the rest of their marketing strategy, because it connects to something else we found in the filings that we'll get to in the few minutes.
Yeah, and the third takeaway is that deposit growth is clearly a first-class citizen for the marketing org. Rich specifically named consumer banking as a driver of that 23% marketing growth. And he said that part of the mandate is to grow checking accounts on a national scale. And also said that consumer banking has an increasing impact on the total marketing line. So we dug a little into the numbers behind that statement, and what we found was good, was cool. So.
Yeah, no, and there's a chart in the newsletter. We'll link to it in the show notes, and if you're in the video version of the pod, I think we'll put it up on the screen. But what it shows is Capital One was paying 3% on their online savings account, which was the lowest in the peer set that Bank of America Research tracks. Bread Financial, just to give some counterpoint, was the highest in that peer segment, almost 100 basis point above at 3.95%. But per the press release that Capital One issued, average deposits were up 1.4%. But the rate they paid on those deposits was down 9 bips. So deposits are up, rates are down, and in the same quarter, they're kind of the lowest rate on the shelf. So that the combination of those things is pretty impressive.
Yeah, it seems almost impossible, right? If consumers are so rate conscious and they only shop on rate.
Yeah, no, and it seems like Capital One, that's one of the things they're really good at, is simultaneously investing really smartly on the performance side while doing the same thing on the brand marketing side. So it's looking like that strategy is working. So strategic brand money appears to be substituting for rate. Now they're able to drive the deposits they need without giving away the farm on rate. So that's obviously a testament to their results on brand marketing. One other thing, I guess just a note here, if you're a challenger bank paying top of market APYs to grow, then just know what you're up against here. There's competitors out there doing this with brand dollars rather than giving the maximum value out to the consumer. Nick, let's pivot to takeaway number 4, because another thing that they talked about was interesting. They actually gave a timeline here to the marketing that Discover brand is going to be doing. So let's get into that for a second. So Discover's acquisition marketing is restarting, and management handed us the timeline. So first, like, some context: Discover pulled back on origination starting in late 2023, and then Capital One trimmed further after the deal closed. Rich called it the Discover brownout, to quote his language from the earnings call. Um, Results from the quarter: the legacy Discover card book shrank actually 1.5% year over year, while the rest of the book grew at 5.3%. So both Bank of America Research and Morgan Stanley put the bottom in that brownout around the fourth quarter.
Yeah, and the restart timeline came straight from the call, right?
Yeah, no, they did. They said half of the new Discover originations already run on Capital One's marketing stack. The rest are going to land by the end of the third quarter. So um, the migration waves: a wave in July, a wave in October, a final wave in January of next year. Um, so Rich's framing on the marketing, as it's mostly a front book thing. They are, um, to quote, learning more into the marketing as we speak and generating a very good flow of applicants. So if we step back with what's happening here, so a national prime card bank, Discover, went dark. We'll call it a brownout, using Rich's words. And now they're re-entering with Capital One's models, budget, all the smarts they've built. They've spent decades building for their branded products. So if you buy media, mail, affiliate placements, and prime, or even subprime credit cards, I think this is worthy of your attention. We think this will be measurable, so this channel mix is going to show up probably in the mail data within a quarter or two. So we'd be watching that closely if we were competing with Capital One.
Yeah, so I'll look at all my direct mail, and the minute we get our Discover application, I'm gonna call you up and say like it's happening.
Yeah, I've gotten one already actually, but it was I think it was on the like checking side. There's a mailer from Discover on the checking account side, so I know they're active already.
Cool. All right, let's take it away to our last takeaway, and it's around credit. So the headline numbers were generally strong. Domestic card charge-offs 4.1%, down 54 basis points from a year ago. Delinquencies down. Reserve that we talked about was released, reflecting what Young, the CFO, called continued favorable credit. As Rich pushed back on the doom narrative directly, he said that they don't see this K-shaped economy that many people are talking about in their own numbers. He thought it was fair enough to add that they don't really play at the lowest end of the market. And we did some digging there on prime versus non-prime. But the sell side seemed somewhat split on what it all meant. And I think the split here is the main takeaway here. So Morgan Stanley's July 22 note read that the reserve release as a sign of confidence in the consumer. They think Capital One might have the strongest credit in their coverage. But B of A's July 22nd report flagged something a little subtler, that June delinquencies followed normal seasonality after beating seasonality for most of the year, which in their words, at minimum, suggests the rate of improvement in credit is slowing. And then also compared with, Morgan Stanley puts out this consumer credit activity tracker, which is pretty strong. We did link it into the note this week. And it does show that card delinquencies are still improving through June. So there seemingly is something better on the credit side there.
Yeah, no, so it looks like good credit, though the second derivative might be turning. So Nick, what do you think listeners should do with that?
So one of the things that we suggest, and we're going to do this on our side, at least internally, is Capital One publishes credit metrics monthly in their AK reports. And so we're going to track that on our own just to see if there's any changes there. But for everyone else listening, if your second half budget assumes credit keeps improving, a lot of affiliate budgets implicitly do, because lender unit economics drive channel spend. The 8Ks may show a turn months before any earnings call admits it. So it's free, it's public, check it monthly. Like I said, we're going to do our best to track that as well.
Yeah, no, so Nick, I do want to comment on one of the things you said earlier, or that you commented from Rich's commentary in the earnings call. He said that we don't play on the low end of the line. So, by the way, what I think he's talking about there is like the very, very low end of subprime, probably between 580 and 500 FICO, something like that, where you'll see other card issuers attack that segment from a marketing perspective very aggressively. I suspect that they're cautious or maybe not even in market at all in those types of segments. But they do disclose some of the mix, just to put some numbers onto this. Um, they said the dollars of loans, 26% is below 660, and then the remaining 74 is above 660. Most banks out there that I talk to draw the line around prime, around 700. 660 to 700 is usually what a lot of folks call near prime. But the narrative out there in the industry is when people think about Capital One, a lot of their branding among their competitors, that they're often viewed as a subprime player, and I think it's because they have their DNA, their history there in the subprime segment. That's really where they built the business, and over the years they started acquiring banks, they started expanding into branded prime products, things like Venture, Venture X, and now you'll see Venture X lounges and airports across the country. I happen to have one in my home airport at Dulles. It's fantastic. Probably even better, to be quite honest, than some of the other, like the Chase and the Amex products I've seen. So they've really, really leaned into it. But I suspect if you were to look at their book by number of account holders versus number of assets, which is how they report, it would tell a very different story. Just give them the credit limits on each of those segments. And all you would have to do to calculate what that likely looks like is take what you think is a normal subprime credit limit and take what you think is a normal prime credit limit and just do some math there to remix what that account mix would look like. So I know a lot of the talk there, Nick, in the earnings call was around heavy spending and around prime and deposits. It was the narrative felt very prime bank, but we can't forget that subprime is a very meaningful part of their business.
Yeah, just to recap, you said 26% of the domestic card book by dollars is below 660. But that 26% seems to contradict somewhat the heavy spenders at the top of the market strategy from Take Two. Can you help me resolve that?
Yeah, no, and I actually don't think there's a contradiction there per se. Strategically, they're going after those heavy spenders. It drives a lot of assets in their prime bank. I've heard folks in the industry talk about this as the barbell strategy. And what that does is it creates nice balance in their card book so that the subprime assets are balanced off by lower risk prime assets. So I think I suspect that a big part of the reason Rich talks about heavy spender and they're so focused there is because it enables them to continue to do business in the subprime market while managing kind of the high level portfolio of metrics.
Cool. All right, let's do a quick recap. So 1.7 billion quarterly marketing budget, up 23%, and legacy Capital One direct marketing is up on its own. 2, spend is growing 26% against balances only growing 2.6%. So a deliberate heavy spender strategy. The third one was deposits growing on the lowest rate in the peer set, branding substituting for rate. 4, the Discover brand re-entering acquisition channels on a published schedule, July, October, January, for example. And then 5, credit is strong, but the rate of improvement may be slowing. We're going to look at the AKs to see if that's actually true or not.
And before we wrap, I know we've talked about the summit already, but just quick reminder, if you're planning to get your ticket, you're going to go register today or tomorrow. I want you to get the early bird price. So if you don't remember how to register, you lost your link, hit me up. I will reply same day, carlos@thefreetoaster.com.
Thanks, Carlos. And as always, the full written breakdown of this news edition that we did with the charts and everything discussed is at thefreetoaster.com. If you found this useful, please forward it to a colleague. That's how we grow.
Awesome. Thank you, Nick. I'll see you next week.
Thanks, Carlos. Bye.